her valuable insight and also expertise in this field and the DSCR. That is something that I haven't done one. Well, I actually have done one in Washington, so I'm familiar, but it's good to hear the perspective on your side. So we'll let you go. So thank you, Dionne.
No problem. So I'm going to do something a little weirdo, and I'm hoping that it works. So I need you to tell me. I need you to tell me if it does, because I don't have double screens.
Oh,
Um,
yeah, that's hard.
yeah, I don't have double screens. So I'm going
Mhm.
to say application window, and then you guys are going to watch me kind of like fuddle around. Um,
That's okay. It's
and
up. I see it.
does it say from bank statements to DSCR?
Yes, ma'am. Yes, ma'am.
Do you see me over here doing something? Okay. And you
Yeah,
can
it's
still see
working.
it.
Yep. Yes, ma'am.
And you cannot see my presenter's view, like with the arrows and with my notes and
I
stuff. You
can
can't.
now. You just went out of the last screen showed the full version. Now it's where the arrows are.
Turn it. Okay, there's got to be a way for me to, you
Well,
know
you
what?
have to be able to advance, though. I think that's your problem.
No, because I can just like click the button and it'll advance. It's just
Mhm.
not,
That's
there's
okay.
got to be
We
a
don't
different way.
mind. We're all family. It's all good.
I know, but I know you guys like to publish this. That's my only issue. And I don't want to
Yeah.
like have like my notes showing like ill. Okay. Let me get out of presenter's view. Let me go back. Okay. I'm just gonna wing it. And then like if I need to kind of like pull something up, I'll pull it up and look at my notes or whatever have you. But um I've wanted to talk about this subject for quite some time. And when Chris and I were looking at the schedule for the oncoming months, I realized that non-QM had not even crossed like our paths. And so I asked her to add this because people keep asking me questions. I've not even done a non-QM class, webinar, or any training for the people in my mentor group. So the NAPMW, you guys are, this is the first time I'm actually doing a non-QM class in quite some time.
Hmm.
And it's so funny because back in the day, people were independent contractors, but now they are calling them gig economy workers. Have you guys heard that? In this new gig
Yes.
economy,
Yeah, I
you
heard
know,
it from Nora Guerra when she
yes,
spoke to us many, many times. So yes, I have heard of it. I don't know about others, but
and all it is, independent contractors. My mom used to say when I was growing up all the time, there's nothing new under the sun, Dionne. People
yeah.
just repackage it and they repackage it and repackage it. And um, if you look at my screen, I don't know if my pointer is going to work. Yep, got a pointer. So if you look at these two images that are kind of like flanking,
So
this
all we
is
see
like,
is you, your beautiful face. We don't see your slide.
get out of here. This
I
is
hate to be
like,
a Debbie Downer, but
no, no, but I need you to, because the whole purpose is for you guys to see the material.
Okay.
Can you see the PowerPoint now?
It is up and it's full, like it's showing your side view and everything. Now it's your full screen. You got it right there.
Cool. So this is the screen that I was showing you guys before. Chris, please edit this out before you publish it. If you need my help, I'll help you do it. Um, but if you look at this, like this is just like a regular consultant. This could be me. This could be me as someone that's like
Mhm.
consulting. This could be a 1099 originator. You've got someone over here that's either doing like nails, they're doing hair, they're doing tattoos, they're doing massages. You've got like the DoorDash people. You remember handyman, and you would see someone that would say, if you need a handyman, call me. They've got
Mhm.
apps right now that would a task rabbit and a bunch of other stuff. And this is the gig economy. Only thing that's happened is that they've simplified the process for you to be able to reach them. Now we have different ways to be able to reach these people. And so what ends up happening? What happens when you when you go from conforming to non-conforming, when you go from, we used to call it, I hate to say this because they don't like this word, subprime,
Mhm.
non-prime. You know what I mean? What's the difference? Well, the difference is that whenever you're dealing with conventional loans, whenever you're dealing with Fannie, Freddie, VA, USDA, there are so many different things that are strictly tailored toward home ownership. Home ownership. So, what does that mean? Like, you can't close in a corporation. You can't, because it's for a person that's purchasing a home. Um, it is, and I don't have it right here, but I just want to say this. Just act like there's 5 boxes right here. It's geared towards self-employed borrowers. It's
Mhm.
geared toward people who cannot document their income well, who can't not show you how much they're really making, because no one is going to the IRS and saying, listen, I made this much money and I want to pay that much taxes. No one's doing that. Everybody
Mhm.
wants to pay the least amount of taxes that they possibly can. And so it gives us an opportunity to qualify people that would not normally be qualified through the conventional, the conforming means. Here's another really good one about this. How many times, I can tell you, I several times, how many times have you looked at a file and the bar doesn't qualify because they own like 17 properties, they own like 16 properties and they're financed? You can't do that with a conventional loan.
Mhm.
We're not even going to talk about FHA, and USDA, but I'm just strictly speaking about, that's where your differences come. Now people can own more than 10 financed homes. Now people can be, self-employed and only show, such like a low amount of money on their tax returns. But if you pull their bank statements, if you pull their 1099s, that's where you see that real money. Now, here's the difference between conforming and non-conforming, between non-QM and qualified mortgage loans, QM loans, is credit scores and money. So what happens when you're dealing with conforming loans? You can go up to 97%, you can go up to 95%. Your credit scores can go as low as 620. You know what I mean? They can, you can buy a house and you cannot have to have all those reserves or whatever have you. Well, when you're dealing with non-QM, you do need a higher score, and you do need about 3 to 6 months reserves. That's not typical when you're dealing on that other side. I will say this. I will not say who the lender was because I don't really like to promote lenders unless I'm in relationship with them. I actually have seen a non-QM loan go as low as 620. So if you do have someone, don't, this is not a slide that's telling you exactly what's out there. This is me just trying to explain to you what is typically needed when you're dealing with non-QM loans. You're going to need about 3 to 6 months reserves, and you're going to need a certain credit score. We haven't even touched the down payment. uh, the lowest that I've seen as far as the highest LTV I've seen has been 90%. And and I know that if someone is going 90%, that score is a lot higher than 640. Okay. Now, there are different types of non-QM loans, and you've probably been saturated, flooded, and everything else with emails talking about which programs they are. And so today I'm going to go over non-QM, excuse me, today I'm going to go over 1099. I'm going to go over the P&L. I'm going to go over bank statements, and I'm going to go over the famous DSCR loan, which is where I'm going to probably have to look at my notes because I haven't seen one. So non-QM loans address most common problem that self-employed borrowers face. What if they write everything off? If they write everything off, then they don't qualify, right? If they go back and they redo their tax returns, some lenders won't touch them. If I'm not mistaken, Freddie Mac does not like tax returns that have been modified. So what do you call it? It addresses a need that's there. But here's one thing that I want you to remember as you start to look at these non-QM programs. When you see these programs, all you see is the glitz and the gold. But what I want you guys to understand is the work that goes behind it. Is it more work than a conforming loan? Absolutely not. Work is work. Documentation is documentation, okay? But the most important part is the business narrative. The business narrative is not really something that you can do yourself. So normally you have that application and you start asking the bar all different types of questions. How long have you worked there? Or what do you do at this position? It looks like you changed jobs. How you earn your money? The business narrative or the business profile is similar to that, except it's about the business that the borrower owns, when they're self-employed. And so now you're asking a different type of question. What I suggest is that you get whatever form that lender requires so that you don't miss anything. Do not go by this slide. Every business has their own. Like I said, I'm not going to name any type of companies out there, but all of them have a business narrative that says the same thing. What's the borrower's business info? What are the revenue payout methods? Why are they asking about revenue payment methods? Because if it's a bank statement program, they probably want to see, what payments should they be counting? What payments should they not be counting? Or ask you to explain, or ask the borrower to explain, if the payments are not in line with what type of revenue payments you're accepting, because it says methods. The expense factor. When does the expense factor come into place? When you're dealing with those bank statement loans, and sometimes when you're dealing with the 1099 loans. Let's dig a little bit deeper. All right, so I'm going to start with 1099s, and I called it the oldie but goodie. And the reason why I called it the oldie but goodie is because 1099 program has been around for years. When I first got into the industry, that was like a really big subprime product. And what would happen is they were, independent contractors, and they would provide us with their 1099s. And what we would do is we would take a certain percentage of those 1099s, and that would be how we verified their income. Now, here's the thing. When it comes to non-QM loans, they're not just taking the 1099. They're more than likely going to want to see the 1099, a P&L, and bank statements to support it. It's no different than a regular loan, because when you complete an application, what does the borrower have to provide you with? A written verification of employment. If it's FHA, you got to provide a written verification of employment and a pay stub, and then a verbal verification of employment. What do you call it? If there's any type of issues, they asking for explanation. It's just different documentation for different things, but it's less. You get to use more of the income. I've seen as much as 90% for the amount that they used. So my husband, who is a barber, he's in the salon suite. He gets those 1099s from whatever credit card companies that he uses, during the year to collect payment. At the end of the year, they issue him 1099s. So we would probably take about 90 or 80% of the gross earnings on those 1099s. That's how we would qualify him. He would provide a P&L statement to show his expenses. This is how much I pay for, suite rent. This is how much I pay for my supplies. This is how much I pay for credit card statements. Once again, showing that the borrower does have the income, because the tax returns are showing the very least amount. Whereas the P&L, you're able to kind of like break it down a little bit more, because you can write stuff off. You know what I mean? The tax returns are just not a great way, unfortunately, to document income. All right, profit and loss statement. So we just went through 1099. I'm on the second one, the profit and loss statement. And yes, that's it. They seriously just want a profit and loss statement. With the profit and loss statement, it has to be prepared by a CPA or an EA. And every time I talk about EAs, I can never remember what the heck EA stands for. I know it has something to do with them being certified by the IRS to do tax returns. They're people and I think it's like an EA number that they have or something. I can't remember, but they are actually certified by the IRS to do taxes. So your P&L has to be done by them. I'm going to venture off and say that they probably wanted to be the person that did the taxes or reviewed the taxes. You're going to have to provide 2 to 3 months bank statements. What is this telling you? Non-QM does not mean that the loan is not underwritten. The whole package is underwritten. It's just documented different. So you're going to have a profit and loss statement. It's going to cover between 12 to 24 months. It depends on which level you pick. Do you want the one where you only have to provide 1 year? Do you want the one you have to provide 2 years? And then you have to attest that they prepare. And then the CPA or EA has to attest that they prepared the most recent taxes. Now, is there a way around that? Talk to your lender. Remember, this is just me looking at all the different lenders and all the products and then me summarizing what's out there for you. Do I think this is a great program? I think this is probably the easiest program that you could possibly do at this point in time. Do I agree with it? I don't know. You guys didn't ask me for my opinion. You asked me to tell you about non-QM loans. But I will say this, the 2 to 3 months bank statements are probably going to be what the borrowers or what the lender's saving grace is. Why? Because when you have 3 months bank statements, it's almost like you've got 5 months bank statements. 4 months bank statements, because that ending balance from that previous month is going to be on there for that first month. And then the second month, of course, you got the new month. So you can kind of see the type of running balance that the borrower has, that the borrower is bringing in. But every AE that I've talked to, this is the easiest. This is the program that they try and push everybody to. But you know what? All of them tell me that people don't usually get it done because they cannot get a CPA to give them a profit and loss for, what do you call it? I think they're like, I guess it's kind of like, what is the thought? You know how like you pay like $1,000 for like a CPA audit or something like that? I think it's so expensive that the bar is like, I'm not paying for that. So they usually kind of go the 1099 route. It's pretty expensive because essentially what they're doing is redoing their taxes or something. Don't quote me. I'm just telling you that that usually the bars, usually the originators that's not their first choice. The infamous DSCR loans. And the reason why the DSCR loan is so popular is, number one, it's not really considered a mortgage loan. It's a business loan. And what it focuses on is the property cash flow instead of the borrower's personal DTI. So what does that mean? That means that the property tells everything. Future income is how I would describe it. And if you've ever seen an appraisal, I think we're doing an appraisal review before the end of this year. I can't remember. But if you've ever seen an appraisal for a single family property that has a rent comparable schedule, you know that there's like this amount that's kind of down there at the very bottom. It tells you what the rental income is in that area. And that right there is what is used to calculate what that number is for DSCR loans. And so they take that rent, they divide it into that PITIA, and they want that number to either be 1 or above. Now, once again, I will say that I've seen lower. I've seen as low as 0.80. But a majority of them say 1. You would imagine that if they're saying 0.80, that there's probably some other stuff that they're going to have to, some other loops they're going to have to jump through if they're allowing that borrower to come in where the rental income is actually not covering the property. It's going to be short 20% because 1 is right on the money. So anything over 1 is like excellent, but 1 is like, okay, bam, you're close, you did it, good. At least you're covering that expense. One of the other things that they love about the DSCR loans is that you can close in your business name, meaning most of those properties by the investors, they buy those properties and then they put the property in that business name. Here's the thing, and this is what I want you guys to think about. It's all about the paperwork. Non-QM does not mean that the loan is still not being underwritten. Non-QM doesn't mean that you still don't have to document. And so you need to get the same documentation that you would if the borrower was employed. You need the operations agreement. You need the articles of incorporation. You need the confirmed signing authority. Why? Because you have to show that all the ducks are in the row for the person who owns the property. Do they have authority to sign? What is the articles of incorporation? What are the operations agreements say about this property? Is there anything in there that's going to compromise, the property going forward? So these are the conversations that you have with your borrower in the very beginning. Do you want a DSCR loan? You want to close in your business name? Okay, great. Start looking for all the paperwork right now because we're going to have to do a business narrative and they're going to need that documentation to do it. Remember, it is supposed to be like a person. So if you were, document yourself, you would have your social security card, you would have your ID, and all that pretty much explains and gives a snapshot of who you are. This documentation right here is giving the lender a snapshot of who the property is, what the property is, how the property operates. Bank statements. Now, bank statements are, I'm going to say that I really, really want you to talk to your AEs about this. Once again, if I had to like label this one again, this is another oldie but goodie. We've been doing bank statement loans for a very, very, very long time. And the reason why is because it's so easy for you to see what's coming in, what's going out, and what's left. And so you would imagine that if somebody had um, so much going out that they had little to no money at the end of every month, you're probably thinking, okay, how are they surviving? You know what I mean? Like, do they have any income for themselves? Are they paying themselves? Because you can see all that stuff on those bank statements. But the expense ratio is determined by the lender's appetite for risk. So that's one of those things you have to ask them about. You can either provide 12 or you can provide 24 months. Um, this one says personal bank statement program. So I'm going to talk about the personal bank statement. I'm going to talk about the businesses. I can't remember if I did. I did. So this is the personal bank statement. Some lenders will ask you some lenders will ask you for at least 2 months business bank statements if you are giving them personal bank statements. If you don't have it, will that disqualify you? Probably not, because if it's a Schedule C, what do you call it? A sole proprietorship. That's why you're providing personal bank statements. It's the borrower's own personal account because they're a sole proprietor. Next step, the fine print. You have to ask your lender if they're going to pull the 4506 for this one. When they say 2 years, they mean 2 years. When they say 12 months, they mean 12 months. You cannot say, well, I opened the account and I have 11 months. That's not 12 months. That's not, that's not 23 months is not 2 years. The deposits and everything have to be consistent. You know what I mean? If they're not consistent in price, then you're probably not even going to get the income that you're looking for. Because remember, it's going to be averaged over 2 years. Here's the really big one: no transfers. I've seen some lenders that say they allow transfers, but they mean transfers to like a personal account, or like, where's that money? Because remember, we don't want to double dip. If you transferred it to if it was like a business and you transferred it to your personal account, if it was a personal account, you transferred it to your business account, and you're providing both of those bank statements to the lender to show that they have money, we can't double dip. So the transfer thing is real, and you have to be careful of that. I always, what I do is when I see what type of deposits that they have, I search for those. And the reason why you do that is because some of them don't break it down. They don't have deposits on one section, and then, debits and all that other type of stuff in the other ones. Large deposit. What is considered a large deposit when it's a business? So the borrower is probably depositing probably about like $15,000 a month. Then one month they have 30,000. Well, that's definitely a lot more than was before. Why is that? Why was it so big? Was it an account that they have been working on? Did somebody double pay? This is the stuff that they want to know. is it consistent? Especially if it's 12 months, because it was it just a one-off? These are the type of questions that they'll ask when they see those giant deposits. So I'm gonna give that example one more time. You've got 11 months worth of bank statements, and they all are about 15,000. One particular month, it was 30,000. Why was it 30,000? Will they back it out? I can't tell you that. You would definitely have to talk to the lender of your choice about it. But these are the questions that you want to ask ahead of time. That's not something that you want to find out after you submitted the loan. You want to know beforehand. Wait, did I talk about business returns? I mean, not business returns. Did I talk about business bank statements? So personal bank statements, it could be 12 or 24 months. Business bank statements are no difference. If you're providing personal, it's because you're a sole proprietor. If you're providing business, of course, it's because you've got a 1065 or an 1120S or whatever have you. That's when that would kind of come into play. So that was there we go. So that was kind of like my spiel on non-QM loans. And my biggest takeaway that I want you guys to remember and to think about before you start asking questions is, yes, the documentation requirements are not traditional. They're not as kind of like the tax returns, but it still requires underwriting. It still requires you to document. It still requires you to ask questions. There's no such thing as an easy program. Like I said, even the what do you call it? Even the profit and loss one, which is supposed to be quote unquote the easiest one, you still got to get with a CPA for them to do it for you, and you got to pay all that money. And CPAs are not crazy. After 2008, they're not doing anything for you to add to the closing statement. They want their money up front. So does anybody have any questions? We got a
I
quiet
relate
bunch.
to some of those talking points though, on what you were talking about. So yeah.
Have you dipped your toe into the non-QM pool?
Yes, yeah. And I did a DSCR in Washington State, and he was a self-employed business owner of a logging company. And I ended up having to flip lenders because the lender conditioned him to death.
Okay.
It was horrible. So he used some choice words and said, I'm not going to work with this lender. You're going to have to find me somebody else. So I
Yeah.
did. He had to pay a little bit more in a rate, but I got the deal done. So it's what's nice about flipping to different lenders with the capability of broker side. So
And the problem always is it's do you have you ever had a conventional loan that was kind of like conditioned like a FHA loan?
just,
So non-QM,
yeah.
unless you've got an old school underwriter that used to underwrite subprime like I did,
Mm-hmm.
non-QM is new and very scary to underwriters. So I
Mm-hmm.
could see them picking the file apart. That's why I was trying to prepare you guys and telling you,
Yeah.
ask these type of questions. This is what they're going to be looking at, because these are not experienced. What do you call it? These are not experienced, like, people that are underwriting these at some of these companies, and you just want to
Yeah.
be prepared.
Yeah. Well, one of the breaking points was they required a CPA letter attesting that this would not be him purchasing the home would not be a detriment to the business. And CPAs are no longer doing those letters. They refuse to do a letter of that explanation. In fact, if you go
And
to CPA like public website, they actually say that on there. We are not doing these explanation letters because it puts them at risk.
not only does it put them at risk,
Mhm.
but you're passing off your responsibility as an underwriter to somebody else.
Yeah. And the
You
guidelines don't show that that's required. And we actually showed them the guideline and they did not care. So we had to leave that lender and it was on the 11th hour. It was very frustrating, but just,
That
yeah.
is frustrating. Oh
Mhm.
my gosh. Well, listen, I have to go. Um, Tasha, and for your question, how you doing, Tasha? They post all of these on YouTube.
Mhm,
So you'll be able to look at the video and see and kind of go over the questions. And I know that you're going to be at AIM, so I will give you my sneak peek of what I'm going to be kind of giving out. And one of those is kind of like a non-QM checklist, because I've been
mhm.
getting so many questions about, like, non-QM. I think it's a great product. I really do want to say that. I'm just trying to give you guys the good, the bad, and the ugly so that you can
Yeah.
do it, and you can do it informed. And
Mhm,
a next example was freaking awesome. You have an
mhm,
underwriter that wasn't comfortable, so they tried to pass that off to somebody else as to what they wanted to do. But
mhm.
this was a great turnout, Annette. We're like increasing. Do you see us?
Yeah. Well, I called everyone and made a point. And what we were finding out was the response that they were getting back was going into their junk. So we just have to be better minded about, hey, look in your junk for this, and it's all
Okay.
good, especially when
I
we have
love it.
new users. And there's a big showing here from our newest local, Gold Coast. I don't know if you know Roy George, he's on, and then of course um, Maya's on, and Tasha, and I mean, I see several of the gals and guys from Gold Coast. So thank you.
I love it. I love it. Well, I will see you guys next month. I'm about to jump on my next call with
Thank
Annette's
you.
people at Nexa.
Yeah, yeah,
And
that's
I
right.
will see you guys later.
Thank you, Dionne. We appreciate
No
you.
problem.